both blockchain and climate finance are both big and rapidly evolving spaces. So in terms of blockchain, you might have heard it also in the context of cryptocurrencies, fintech, but blockchain is also used for non-financial applications such as supply chain, and also within the context of distributed ledger technology, which is much more than simply the blockchain. It's linking to smart contracts, Internet of Things, big data, AI, and sort of all of this digital platform that's continuing to evolve. So when we use blockchain, we want to be careful to also convey to you that there are these related digital technologies that are also part of this mix, and how these tools can be applied for not just climate actions, but again to facilitate climate finance. So in the case of digital currencies, and you might have heard of ICOs, initial coin offerings, which had a phase where they rapidly went into the marketplace. Some people were able to raise capital very quickly, very cheaply, and that wasn't entirely successful. But as in a space that's so new like blockchain, a lot of quick starts, fail fast, lessons learned over the last 10 years that the technology's been around. And in the climate space or sustainability space for the last 5 years or so, there's somewhere around upwards of 1,000 blockchain for good initiatives. So there's clearly a lot of interest in using the technology to enhance what a lot of initiatives have been doing. There's some new programs. You can find a lot of this information just Googling it on the internet. However, in addition to some of these specific types of applications, there's also a lot of work that's starting to happen at the system transformation level. So looking at the digital economy broadly speaking, and how can we respond to the call for urgent, scaled actions to achieve the global goals, so the Paris Agreement and SDGs broadly speaking. And so today's panel will give an opportunity for you to hear about some of the latest work that's happening, and also the outlook for the technology and how it's being applied specifically around climate finance. So with those words, Lauren, if you'd like to give a bit of an overview of climate finance and set the stage for the panelists.
Hi everyone. I'm Lauren Carter and I'm with UNDP. I run something called Invest for Climate, which is a joint partnership held within the UN and the World Bank designed to catalyze private investment in climate action. And so one of the things that we're looking at is how kind of innovative both technologies and finance mechanisms can be piloted and explored in countries to access and accelerate climate investment. So one of these is blockchain and the related technologies around IoT, AI, et cetera, big data. And so one thing I think that, Tom did a good overview of blockchain and all the kind of complexities around some of these technologies and all the different use cases for them, but also the broad topic of climate finance is a bit confusing, and also to a certain degree not totally agreed upon by all different stakeholders. But essentially for the purposes of this conversation, it's both public and private and obviously blended, so having many different stakeholders in a deal, and it's meant to kind of address both mitigation and adaptation actions. And also, again, with the other issues of measuring kind of climate finance, you run into issues of, the viability gap. So with certain infrastructure deals, what's only counted as climate finance is the part that actually improves the resilience or reduces the carbon footprint, which can make it another layer of complexity for actually calculating what exactly goes into climate finance versus kind of regular infrastructure, et cetera. So with that in mind, what we're looking at within UNDP for certain examples of what blockchain, these related technologies can do to de-risk investors moving into, for example, infrastructure projects in emerging markets. One of the biggest barriers that we see to investment in these countries is actually just the risk of the country itself. A lot of these infrastructure deals are 15, 20, 30 years long, and a lot of investors feel uncomfortable sometimes getting into these markets, even if the current government is favorable, the legal structure is there, they don't know whether or not there's going to be a certain regime change that changes the laws, or if the judiciary framework is such that they can guarantee a speedy trial in the event that there's any sort of discrepancies between the contract that they feel with the government. So one of the aspects that we're looking at is how smart contracts may be layered in with a guarantee function can increase investor confidence for moving into an infrastructure deal in a country where the legal framework is tied onto that smart contract. And then also issues around land titles and how I think, for example, in India, McKinsey estimates that 1 to 2% of GDP is lost annually due to disputes around land title issues. So there's a growing movement to put blockchain, or to put land titles onto a blockchain, and not withholding the challenges of actually identifying the land title themselves, but once put on a blockchain that makes, that increases investor confidence and reduces the threat and fear of litigation around certain deals in the infrastructure space. So those are some of the broad categories that we're looking at where blockchain and some of these related technologies can add value and de-risk investors into moving into some of these emerging markets. But we have a wonderful panel here of people from a variety of different industries, all looking at the ways that blockchain and related technologies either de-risk, add liquidity, improve monitoring and verification, and also access to climate markets. And so I'm going to let everyone take 2 to 3 minutes to kind of introduce what they're doing, and then we're going to go into some more detailed questions, and then hopefully we'll be able to open it up to Q&A at the end. So with that, Chow, why don't you pick it up?
Good morning, everyone. I'm Chow. I work for Liquid Token and Good Bank. What we do is we're trying to make traditional capital markets more efficient and feed through more capital and investments into climate finance. And the way we do that is by offering projects investment by equity or debt using tokenization technology, as well as building marketplaces so that people can then invest in impact tokens, which is redeemable on sort of marketplaces. So I'll talk a little bit more about specific projects a little bit later on, but a lot of what we're doing is trying to increase capital flow into impact projects.
Hi everyone, my name is Brianna. I work for Syndicatum Sustainable Resources. We are an investment fund that invests, operates, and develops renewable assets around Southeast Asia and South Asia, only in developing markets. And as investors and developers, we have recognized that with the feed-in tariff and government subsidies being reduced and rolled back in a lot of these markets, there was a need to add an additional revenue stream or add liquidity to the market. So we just recently came up with a nonprofit subsidiary blockchain-based renewable energy credit trading platform. So that's how we're using using blockchain to kind of offer some liquidity, additional revenue stream to assets in the market. We've also just partnered with a company to help to democratize investment into to bigger investments, specifically by offering tokenized investment at about 100 to 150,000 smaller ticket size investments. And we are actually doing bundled renewable energy credit platform tokenization with those assets as well. So we're kind of using it across the market. I think we can talk a little bit more about how we're specifically using it, as we said, a little bit later on.
Hello, I'm Stephanie Rogers from the World Bank. I work in our carbon markets and innovation practice, and I'm here to connect the climate finance and climate markets pieces and tell you about how we are prototyping the use of blockchain and other emerging technologies to support carbon markets post-2020 in the era of the Paris Agreement. And just as introduction, to make a bit of that connection, we know that financing the least cost 2-degree pathways is very expensive. Some estimates are that there are $700 billion a year of incremental investment needed to stay on that pathway. So we think it's really important to use climate finance intelligently, concessional finance, and to leverage private sector investment via climate markets. Both results-based climate finance and climate markets require certain attributes that can be enhanced through the use of blockchain technology. So, for example, we're looking for transparency of both asset generation and transactions, measurability of outcomes, environmental integrity, and lowering transaction costs. I'm working on an initiative that we call the Climate Warehouse, and we're looking to design and provide a proof of concept for a new infrastructure for global carbon markets in an era of bilateral cooperation between countries. So in the context of this infrastructure, which is comprised of a database, registry, and meta-registry functions, we've been prototyping how blockchain and other technologies like Internet of Things can lend credibility and lower transaction costs for the generation of mitigation outcomes and the recording and tracking of mitigation outcomes, which are the new type of climate assets or carbon credits across jurisdictions. One of the key features of bilateral cooperation between countries under the Paris Agreement is that countries will have to make accounting adjustments in their national climate targets to demonstrate that assets have been transferred from one jurisdiction to another. So in terms of the international infrastructure, we think that blockchain has an application in terms of avoidance of double counting of those climate actions. And I think for these initial comments, I'll just leave it at that we are prototyping asset generation in partnership with the government of Chile. So I can talk more, I think, when we talk about MRV and how blockchain applies there. And then also on the infrastructure side with regard to this meta registry. Thank you.
Thanks. Yeah, hi everyone, I'm Owen and I'm from the Gold Standard Switzerland. We're a standards and certification scheme for climate action and sustainable development goals. We were founded 15 years ago by WWF to mainstream SD in carbon markets. And we do that in 3 key end-use markets, so corporate reporting, impact funds, and you probably know us best from the carbon markets. But 15 years later, those 3 channels of funding still face big barriers. If you're a funder, it can be hard to parse out what you want from the market, what you need in terms of meeting your own requirements or the market requirements that you play in. And for project proponents, it's expensive and impractical and time-consuming to actually implement an action. And so we have 2 big things going on right now. Within the gold standard, we are fully digitizing in the next couple of years, so our standard will be entirely online and will tailor itself to the use of the proponent coming through, whichever pathway they're coming through. And we created a new entity called SustainCert, which will kind of has a mandate to innovate in technology for certification. But we're also a leading partner of the Climate Ledger Initiative in Switzerland, and you may have seen our navigating blockchain for climate report to get it the right way around last year, and you'll see more thought leadership in this coming year. And that identified a number of hotspots, and the one that I'm leading on is called Next Generation MRV, and that's all about holistic use of disruptive technologies like Tom mentioned to reduce the upstream costs and time. So how can we use technologies to disrupt the MRV process and maybe even make it VMR, verify, implement the technology, calibrate it, verify that it's being used right, and then automate the MRV process. And that can have benefits like reduction of cost and time, but it could also increase the value of assets. So in the carbon markets right now, you verify, say, every 3 years, and you issue 3 years back, so your oldest credit would always be up to 3 years old. If we can issue in real time, then you'll always have up-to-date credit. So it can reduce both the time and the cost of MRV, but also increase the value of the asset issue. And we'll be doing open calls for use cases, some will be funded this year as well.
Great, thanks very much. In addition to my role as a co-host and a co-moderator, I'll be one of the panelists as well. But before giving my spiel, I just wanted to let the folks know in the back that if you're looking for a chair, there's still about 4 chairs available up here at the front if you'd like to grab it. It might not be easy to see that there's those chairs. So in addition to my role with the Climate Chain Coalition, I'm involved with a few other blockchain initiatives outside. One of those that's relevant for this workshop is called Adaptation Ledger. And so adaptation has generally received insufficient attention relative to mitigation and climate in general, even though it's one of the core pillars. And so you might know adaptation finance is significantly lagging the climate finance into mitigation and renewables and so on. And indeed, I think it's something like maybe 5% that relative to mitigation. And of the adaptation finance, about 87% of it is directed towards disaster response. So that's after the climate impacts. And so a very small portion of a very small portion is going towards resilience building. And so how can adaptation finance be scaled significantly, cost effectively into the the most value for money areas in terms of value for adaptation investments. Adaptation is a challenging area. Not only is it one of the pillars of climate, inherently it's multidimensional. It spans sustainability broadly speaking, and of course there's a number of policies out there. So how does one address the need for scaling adaptation finance systemically or holistically with the policy coherence beyond the Paris Agreement, for example, the Sendai framework and SDGs and so on. And so we're looking at utilizing not just the blockchain, but these other digital innovations within the adaptation space to create a platform and a framework that can help scale the variety of different context-specific adaptation applications. And so later on in this discussion, I'm happy to describe a little bit more on one of the pilots that we're doing this year.
So I guess just to kick it off, this is probably more for Brianna and Chow, but how do you see blockchain as crowding in private finance? How do you see it as improving liquidity? What are the kind of value adds for this and kind of accessing new investors, kind of moving away from just institutional investors to a broader spectrum of players into some of these either renewable assets or some of these more traditionally more complex assets, such as either forests or some of the other assets that you're putting on liquid token?
Sure.
We're splitting it by equity and debt.
We're splitting it by equity and debt, so everyone knows. So there's a couple ways that we're working on that. As I mentioned, we are working with a blockchain platform that offers through STO, through security token offerings. We basically offer up a platform for accredited investors predominantly, but smaller scale investors, personal investors, retail consumer, to get involved in renewable energy assets. So traditionally, and our main fund actually is, our LPs are only mutual funds and pension plans. Those are the types of investors you would typically see in large renewable energy assets, mostly because of the time horizon required and just simply the capital available. So what we're trying to do is use tokens to offer an equity stake into renewable assets, as I mentioned, at a smaller ticket price, anything from 50, 100, 150,000, as opposed to the traditional 20, 50 million that has been required. And so what we do is we offer investments into for short term, so you can liquidate via an exchange platform, a cryptocurrency exchange platform, at any point in time, but typically, except for the US, but we only allow investors from accredited countries as well. So we work right now with 15 countries globally that we have already done the compliance and regulatory kind of KYC with, and they have kind of registered to be investors into our platform. So as Syndicatum Sustainable Resources, as a fund, we actually invested into this business, or we are about to invest into this business as equity holders, and then we will receive tokens as kind of a guarantee of the equity. So at any point in time, we can issue those on the exchange if we'd like to liquidate, but generally speaking, those tokens are expected to increase in value, so over a long period of time, we could recoup our investment as a traditional IRR.
Can I just get a gauge of how many of you actually understand STOs? A few. Okay. All right. So rather than talk about sort of markets build, what I'm talking about is more how do we bring traditional capital markets and people who want to invest into assets that they could traditionally not have access to. So we're not talking about fund managers, LPs, who normally would have some choice. We're talking about maybe a person with a private superannuation fund, or someone who's a professional that wants to have access into some impact investments, not just in terms of renewable energy like solar and wind, but also maybe sustainable projects such as reforestation, sustainable farming, mangroves to mitigate against storm surges, to protect livelihoods. So we're talking about projects that would traditionally find it very difficult to get financing, either through debt or equity. And so how do we make that access a little bit easier? So apart from people having an investable interest in terms of buying an equity stake in a project, there's also the debt options. And so traditionally what we see in the debt options is, okay, the World Bank, for example, issues green bonds. Now, green bonds are only really available to institutional grade investors. If we as a public wants to participate, we can't. The previous employer that I worked with, the Commonwealth Bank of Australia, worked with the World Bank to issue, I suppose, the world's first bank bond on the blockchain in August 2018, and that was a $110 million kangaroo bond with a 2-year term. Now, earlier this year, in March or May 2019, they then enhanced it to be able to offer for secondary trading. And the reason why you need to enhance debt instruments for secondary trading is that then you provide added liquidity, optionality to people who took on the initial investment, taking on sort of the perceived risk. It doesn't mean that they will liquidate, they just have the perceived optionality so that if they do need to resize their portfolio, they can. So that's how it's moving towards sort of the traditional bond markets. Now, in March 2019, Spanish bank BBVA then issued the first green bond on the blockchain, and that was like a structured finance debt instrument. So we're moving towards sort of traditional markets into green bonds, and then what next? What next is basically all the smaller projects, all the sort of 5 million, 1 million, maybe 10, 15 million, that have struggled to get either financing because they're greenfield, or they've borrowed at a very, very high rate because they're in a developing country, have very tight access to capital, and they want to refinance. So you can look at refinancing that debt, or you can invest in equity on sort of newer greenfield developments. And what we're trying to do is look at sort of aggregating some of these smaller projects so that there's a sizable sort of economies of scale, which then we can package and then link to a green bond to then offer secondary liquidity to people who are taking the first mover advantage. So there's many ways you can participate into climate finance. It depends on what your preference is in terms of really hard assets such as renewable energy, or if you really believe in things like mangroves and forests or sustainable agriculture or blue ocean projects. Making these projects available to the everyday investor is what we're hoping to try to achieve.
Great, thanks very much. I'll switch up the types of questions here and direct one towards Owen at Gold Standard / Climate Ledger Initiative, which recently released a report, and I know one of the areas of focus was digital MRV and MRV of climate finance in terms of fiduciary duties and tracking that climate finance. So if you could elaborate on some of that work.
Yeah, so so there's a few things I think we're trying to tackle with that, and Tom alluded to it in the first kind of opening words, was around trying to make this a more holistic effort. So it can be quite tempting to take a technology and find the most exciting thing to do with it and make a case study, but coming from the world of standards, trying to make practical changes and to introduce scale through cost reduction or improve practicality is a much more holistic effort. And so that whole digital MRV approach is all about taking our more traditional standards way of working and looking at the suite of digital technologies and seeing which is the most appropriate. So looking at, for example, in the case of clean cooking or renewable energies, looking at IoT, in the case of verification, exploring how machine learning can help us set conditions to automate verification. So we don't come at it from a one-size-fits-all. We don't think there's a set of technologies that solves every project type. Some project types will likely be more suitable or more easily disrupted than others, for sure. But the whole approach is all about taking a look at each project type and seeing what the most appropriate solution is. In terms of DLT itself, so we've kind of gone back and forth on its usefulness in terms of upstream MRV, and generally our thinking was, and has been recently, that it has to be more holistic. You have to look at which technologies are most appropriate to disrupt which use case. But I think where it can be useful is in the glue that holds all that together, and also in the glue that carries the data from upstream MRV into downstream transactions. And we had a conversation this morning just about how much real data we already produce upstream in terms of project level MRV that could be useful later on. It could also be quite painful because there is just a lot of data to be stored, and some of it isn't that instructive to bias. But certainly when you talk about smaller kind of private buyers or individual buyers, seeing the story of where, say, a credit came from can be really compelling. But also, I think it can help us deal with some of the permissions that allow you to play in certain markets, like Corsia, which will require certain permissions, or even where two project types might double count with each other at the MRB level. So take Clean Cooking and Red Plus. There's an inherent overlap between the deforestation parts. And so by kind of automating and carrying that data in an immutable way, we can hopefully disrupt that too.
Yeah, I think those are some very important points there, and especially the asset-backed tokens, these sustainability assets, and being able to pair up the climate finance budget and say the carbon mass balance budgets to ensure that all of the variety of actions within an NDC context do ensure that we have the environmental integrity as well as the data and market integrity go along with it.
I just have an example of an MRB pilot, maybe to give you all something to wrap your head around if you're not in this space. So the World Bank has a technology and innovation lab that's looking at applications of blockchain and other disruptive technologies across a wide span of World Bank activities, not just in climate. And as a result of that collaboration with those colleagues, we produced a report last year called Blockchain and Emerging Digital Technologies for Enhancing Post-2020 Climate Markets. Out of this report and related work came a pilot with the government of Chile. And there, the Ministry of Energy has a program that's piloting rooftop solar installations on public buildings. So blockchain in this context is used to store the data, of course, but also in conjunction with Internet of Things to gather data on rooftop solar generation via nodes that are located on the roofs. So I visited one of these installations. You have the solar panels, which are physically connected to a traditional data logger system that measures the energy generated. But in this case, the blockchain node, which has its own mini rooftop solar panel, is collecting data on aspects like location, of course, temperature, and then, of course, its own measurement of sunlight. So that data is used to cross-check the validity of the data that's logged from the physical equipment. And really, the goal here is to pilot the capture of that data, potential benefits for verification, both in terms of speed and perhaps avoidance of transaction costs and verification, as Owen was describing. And then finally, to prototype taking that data and connecting it to a national system, such as a registry system, directly. So instead of going through different processes that take more time, it might be possible via blockchain to connect directly to the national government's record of the renewable energy generated, and also to the market. So through smart contracts, et cetera, transactions will be prototyped in the future. But just wanted to bring that down to an example of a program that you can imagine. Very simple, installation, but perhaps a very impactful application.
And I just want to add to that. We're working with Nature's Coin, and they basically tokenize coins for investment in mangroves in Myanmar. So far, they've planted 6 million trees through drone technology. And the drones basically enable 100,000 trees to be planted per day, because can you imagine walking through some mud flats and getting stuck? It's very hard to do that sort of planting with impact without technology. In addition to using technology is satellite imaging and related technologies to be able to capture what type of carbon is stored. Now, most of the carbon with mangroves forest is stored in the first 1 metre of sediment. So we need more efficient data and correct data to be able to capture the amount of carbon that's stored through these mangrove forests, and hopefully through developments, we'll be able to then bundle that into sort of carbon credits, which then add a financial incentive for more investors to invest in sort of projects like the mangroves reforestation.
Yeah, and I was interested, as a follow-up question to both of you guys, was around the business case for these disruptions. So take a case close to my heart is clean cooking. We can introduce technologies on the stove itself to track usage rates, but they're quite expensive. If they weren't, we'd have done them already. So we have to have a holistic business case that reduces the cost or increases the value somewhere else, whether it's through verification or increased value. So I wonder maybe in other cases how you go, or maybe there is no business case, I don't know yet, but yeah, maybe it's
I can speak to that a little bit, kind of unrelated. So we're using a new IoT device with a company called Ledger that's actually famous for their hardware devices for storing cryptocurrency. They've partnered with us to integrate on our renewable energy tracking platform. So instead of physically sending an engineer to go and inspect the devices, inspect solar farms, make sure they're actually operating, make sure that it is clean, we have installed these little devices that are very easy to replicate. They're just kind of little microchips that connect immediately into the smart meter and then into our blockchain, and they just stream data live. They're very cost effective and they're easy, as I said, to disseminate. So that's where you would kind of be able to bring the average cost down in general. I mean, I'm not sure how you guys are using it, but for us, that's been a hugely relevant kind of business case, and it has really minimized our costs in terms of sending engineers out, obviously, reducing our carbon footprint by flying engineers around the world and the costs associated. So I think that's something where you would have the chance to really automate technology and also make it more cost effective.
Just in addition to the solar, we're working with a company to tokenize their debt and equity investments into their solar farms. And basically what they use is they use solar panels with basically like SIM chip technology. And the SIMs basically send digital data on a per-hour basis, which then is collated and assessed and verified, and all that is put on the blockchain. So then there's a sort of chain of command and verifiable data and all that sort of stuff. So we're working on sort of those technological developments to enhance sort of the reporting side of things as well.
And I just have a general comment on how blockchain affects the speed of transactions, and that might help companies that are looking to implement mitigation activities. So I think climate financiers have trended toward results-based climate financing, basically payment for results achieved. And in order to pay someone for results achieved, you have to have credible data. I think businesses would prefer upfront financing, and so the faster we can make that process of recording, verifying, and then transacting results, the better. And Owen and I had a discussion this morning about whether these technologies can really replace traditional verification processes, but I think to the extent that they can lower the time needed for verification and increase the frequency of issuances and transactions, that can be helpful to those who are implementing actions so that they can be paid for results faster.
Yeah, I totally agree, and I always get accosted by verifiers at conferences concerned about their business models. So the way I see this as a standards operator is that the verifier still has a role here, and if anything, it becomes enhanced and makes better use of the skill set. So one of the things I think that we alluded to in the question I asked was that there's a lot of manual handling of data. If you can manually handle data, that it just wastes a lot of energy and time and cost. And verifiers do a lot of that, and you have my sympathy if you're a verifier, just sifting through so much information. So we don't target you very well. And I think if we can look at verifiers taking a step back and looking at a more programmatic level or a longer term level, and waste less time on kind of manually sifting through rubbish data and more time on whether things have been calibrated correctly and looking at kind of the softer, more difficult things to verify, like inclusivity and safeguards, for example, then I think it actually changes the role for the verifier for much better.
And verification isn't always about, just things that you can't touch and see, and technology and drones and satellite. It's often on the ground verification. So when you've got forestry projects, for example, you use you get local community engagement. You get them to go out there, you pay them, take pictures with their snap, iPhones, digital cameras, send the images through. That is enhanced with other information and data, which then adds to the whole verification process. So it's not just about a faceless process. You also have to have community engagement in order to make these projects work. And why we're financing these projects? Because we want these projects to work, and that's just as important.
There's also judgment that has to be deployed in terms of the quality of the data that is put in. So especially when we talk about things like environmental health and safety, you can automate a process, but you have to be able to capture both the information that's desired and the quality of the data really determines the output.
Yeah, there's also another project being done, for those of you who are familiar with the Climate Policy Initiative's Global Lab. They have a working group that I'm participating on with a blockchain climate finance instrument that is it's a lot of words at once. It's a micro-insurance product for sub-Saharan African farmers that does micro-insurance payouts in the event that there's a natural disaster, a drought, or some other kind of crisis, and it helps with the speed at which you can, because when you're a subsistence farmer, it's really critical that if your family is counting on the outputs of your crops, you don't really have time for a verifier to personally come there and check and certify and make sure that yes, this happened, and also by putting it onto a smart contract. Again, you don't advertise any of this to the farmers themselves. They don't care about blockchain. They just want to make sure that they're going to get paid at the end of the day. So you kind of don't frame it in this context, but you make it so that these farmers have access to. You even have GIS and kind of satellite images that can view whether or not your plot of land, which is kind of linked to these GIS coordinates, whether or not that's vulnerable to some of these climate risks, and you get a kind of automated payout that's done on a smart contract. So there's a lot of opportunities for this from everywhere from the family office piece and kind of accredited investors looking to get in on some of these still substantive ticket sizes, but not at the $50-100 million piece, all the way down to the most vulnerable populations who are also getting access to services like micro insurance, but also payouts for things related to managing the carbon credits around mangroves. So there's a full spectrum of ways that again, when we kind of started this conversation, I wanted to make sure that we knew that the way that we were addressing climate finance was really, really broad, and it encapsulated everything from pure private investment to blended finance to public, and a lot of public finance is going to be much more concerned with this monitoring and evaluation and reporting of whether or not the project is actually delivering on what it wants, and the private investor really just wants that liquidity. They want to know have the piece of what they're investing in, et cetera. I think, Chow, you were mentioning before when you were talking about the panel, how LPs wanted to be able to exchange between themselves to move into other, investments, et cetera, and that what you guys were doing was enabling that kind of liquidity in the market. So we're really talking about, most vulnerable people in very difficult, tough environments, all the way up to very, senior and sophisticated investors. But with that said, blockchain and these technologies are not perfect. There's still a lot of challenges. A lot of people are still in this pilot or white paper phase of exploring, what's possible, what's conceptual, et cetera. And some people have actually kind of managed to actually take some things, into the field and see where the barriers are. But one thing that I think we were talking about is that blockchain still has a lot of challenges. Some of those are legal and regulatory. Other ones are the high upfront costs of dealing with some of this stuff. I know that a lot of people advertise blockchain as lowering costs. And yes, it does and it will, but there's a lot of upfront costs that go into actually coding and designing the infrastructure that's needed. There's a lot of conversations before about how blockchain was going to enable peer-to-peer energy transfer. It does, but you still need transmission lines and physical infrastructure to do that, and that costs money. So, it's not a perfect system. We're also seeing a transition from proof of work, which was a little bit complex, high energy usage, then we're moving towards proof of stake, proof of authority, proof of consensus. So we're moving through also all of these different kind of applications around what blockchain technology even looks like, and who verifies it, and how actually decentralized it is. So with that, do any of you guys, maybe, Brianna, I know you guys are doing some of this stuff in the field, but do you want to maybe kick it off with some of the challenges or barriers that you've seen with actually implementing, some of the blockchain technology in your, kind of both sides of the house?
Yeah, so blockchain is very expensive to build. So we built a proprietary blockchain platform. Obviously, if you're looking to do something like that, it is, cost intensive, labor intensive, and time intensive. So that component of it, I would caution against if it's something that you're looking into. You need to have a really solid use case. That being said, the Energy Web Foundation has built their own blockchain. They're looking to kind of license it to a lot of companies for more commercial uses as a platform to build applications on top of. So with that, they use a proof of consensus or proof of authority model, which means there's a select group of kind of consensus nodes that are predetermined, and they really minimize the amount of energy that is consumed when you are adding a new layer of blockchain onto a block, basically. So that's a really good kind of best case example in terms of minimizing the energy consumption. As far as the costs associated with regulatory, legislative, compliance matters for the investment side of business that we're focusing on, I mean, in order to get accredited investors in these 15 countries that we have now been approved with, I mean, that's huge in terms of legal work. It is an upfront cost. I think that's a very unique use case for us. I can think of another example. I'm sure some of you guys have heard of WePower. They've gotten a lot of publicity recently. Very, very successful pilot case based in Lithuania, and they're trying to democratize investment into renewables, but at a retail, personal consumer level. And what they're doing is offering tokens to individual investors through an exchange for future electricity rights. So a reduced price on electricity in the future once the asset has been developed. I mean, this is something where there isn't a huge upfront cost, there isn't a huge regulatory burden, and I think that's where using blockchain is a really huge advantage that you wouldn't be able to benefit from if you were to use a traditional ledger system. So I just wanted to touch on that briefly. It was something we were talking about a bit earlier as well. But yeah, I mean, the other thing I think that I'd like to touch on with respect to the hurdles you find with the blockchain in general is more its public persona. So when I go to speak to renewable energy producers and developers around Asia who are not really that familiar with the technology and its use cases, its benefits and advantages, they immediately think, well, there's been so much money lost in the system. Exchanges have been hacked and cryptocurrencies have been volatile. And I think we have to think a little bit about decoupling the cryptocurrency from the blockchain platform. And the technology of the ledger itself is a really valuable data storage and verification platform independent of cryptocurrencies. So I think that's something that, me personally, I spend a lot of my time educating people. And I think we're going to continue to experience this going forward for the next couple of months or years as we wrap our heads around the optimal use cases of the technology platform, similar to in 2000 when the web came about. And I think identifying the difference between a cryptocurrency and a blockchain is going to be a real focus point for a lot of companies going forward.
Talk a little bit more on top of that, and I'm talking about sort of traditional capital markets. So if you go to an IPO, for example, it's a quite expensive and lengthy exercise. Going through an STO doesn't mean that you avoid that. You still have to do legal offer documents. You still have to comply. You still have to do all the standard things. What blockchain and distributed ledger technology enables you to do is just to optimize the sort of the spectrum of when you start to issue to when you trade. It reduces that sort of process through just making it instantaneous. So it doesn't alleviate all the things that you have to do. You still have to do them, so you still have to comply. They are securities first and foremost. So that's one thing you have to remember. They're not cryptocurrencies per se. And so the perception of cost needs to be adjusted as well. So it doesn't mean you get it free because it's blockchain. It just means that you might have lower costs because you have less steps along the way, or you might have less middlemen along the way because some of those processes are automated.
I think one quick comment on that with the STO. This is a relatively new concept that I think is kind of like the IPO for cryptocurrencies, but 2.0. Because we started with ICOs that I think many of you, I'm sure you're familiar with, where there were white papers drawn up on the back of completely fraudulent or non-existent companies. And